Welcome back. Well, the markets, they're trading more or less sideways, actually. The Nifty is unmoved. The problem today is the mid-cap index. It's actually starting off on the back foot, and that's taken a bit of a knock. So just keep an eye out on that. You have Vodafone Idea that's up close to around 9% as we speak. I think the only alert that we have is the reappointment of Mr. KM Birla. He's been appointed as additional director. So I don't know whether there's any fresh piece of news, but Vodafone Idea is up close to around 8 to around 9% as we speak. But as promised, let's get to our next corporate. ICICI Pru Life, they reported a strong set of numbers in the fourth quarter. The company achieved the target of doubling the VNB in 4 years. Well, to understand more about that, we have the management with us. Mr. Kannan joins us on the show. Well, Mr. Kannan, thanks so much for joining in. What's the target for the next 4 years now? You know, in the immediate term, could you tell us how do you see the VNB going forward? And also, what's the VNB margin target, Mr. Kannan, for FY24?
Yeah, thank you. Thank you, Nigel, for having me on your channel, and good morning to all the viewers as well. As you rightly pointed out, 4 years back, I had promised the street as well as our own board that we want to be doubling our VNB in this 4 years' time. So as you said, I'm very happy to report that we have actually more than delivered on the target. We have more than doubled our VNB. And this particular year, we have seen a growth of 28% on VNB year on year. And particularly for the fourth quarter, we have seen a 36% growth. So this has been our VNB performance. You talked about what is in store in the future. So two aspects I want to highlight to you. One is that the opportunity is intact for life insurance in the country, and more so for protection line of business. So in this overall context, with the regulatory tailwinds also with us, I do believe that we can grow the savings line of business in line with the nominal GDP growth rate of the country. But protection, and within the retail protection, has more room to grow because we are coming out of the pandemic. Because of that, the base is very low. There have been a lot of supply side constraints when it comes to retail protection business. And finally, after showing some sequential growth in the few months leading up to March, we actually saw a year-on-year growth of 28% in retail protection business as well, which is a higher margin business. So all in all, this would be the outlook from the top-line growth perspective. You talked about the VNB. Yes. Our focus will continue to be on absolute value of VNB. So I do believe that the VNB going forward would be driven more by the top-line growth. And not to say that margins cannot improve, because as I said, with the retail protection being a higher margin business, getting a higher proportion of our product mix than what is there currently at 17%, there could be an increase in the margin as well in the medium term. So all in all, the potential is there to further probably double our VNB in 3 to 4 years' time. But as you know, we are going through this succession plan. Anup will join. He will succeed me in June. So he will be articulating a specific target going forward as well.
But can double VNB in 3 to 4 years' time as well, the absolute numbers. But of course, take your point, Mr. Kannan. Good morning. On APE, will you see growth in APE in FY24 over 23?
Good morning, Prashant. Definitely, because if you look at our own performance in the last 4 years, if you look at non-ICICI Bank channels, we have actually grown at 18% APE on a CAGR basis. And last year, even including ICICI Bank, we grew our APE at 20%. And given that ICICI Bank declined during the current year, rather financial year 2023, at 38% year on year, still we put out an overall growth of 12% APE. So I think more than green shoots have developed on the growth side. So I do believe strongly that in FY24, there would be a growth on the top line as well, apart from VNB growth.
Will it be a low? I mean, what kind of, could you give?
I don't want to speculate as of now.
Low single digits, mid single digits? What kind of?
Oh, clearly double digits. There's no question about it. I think clearly double digits, given that, as I said, the savings line of business has the potential to grow at the nominal GDP growth rate, and retail protection having a lower base growing at a much higher rate. Clearly, double-digit growth is what I would see for financial year 24.
Okay, so double-digit growth is what you're looking at for financial year 24. Mr. Kannan, good morning. But, you know, with this growth is coming elevated costs as well. So I wanted your thoughts on that. You have in the recent past said that your costs will continue to be elevated, but the cost ratio at the end of FY23 was over 20%, 21.5%. Do you see it go beyond that in the near term? And also, there are these recent budget changes where you will have to spend higher on distribution. Would that continue to keep your cost ratio elevated as well?
Sonia, good morning. Thank you for having me on your channel. So you talked about the cost growth. First of all, I want to say that our VNB numbers are after taking into account the full expenses. So what you see as a 28% growth on VNB year on year is after taking account the cost fully. So the way we have been working, Sonia, in the last 4 years is that not only we had to deliver the VNB during this period, but we also want to invest for growth. So that is what we are seeing coming through. Specifically, we have invested in the proprietary channels, including agency and direct channel. For example, in agency, we have increased our managerial staff, the frontline managerial staff, by about 30% during the year. But typically, the output or the productivity of agency develops over a year period. So while we are focused on VNB delivery in the short term or the medium term, we were also focused on a future growth and laying a good platform. So to that extent, I do believe that this will play out. And as I say, that VNB takes into account the full cost. What we have delivered, 28% growth in profits, is after accounting for the full expenses. And as I said earlier, the VNB margin could be stable or going up going forward. The second question you asked about the expense of management changes, these are regulatory changes, not from a budget perspective. But again, I can assure you that we are already within the limits stipulated by the regulator. And the expectation of the regulator on the industry will also be, while there is a leeway which has been given, that we would operate within that. And over a period of time, I expect them to bring down the expense of management limits as well. Because ultimately, we'll have to give a good proposition to the customer while ensuring viability from our perspective. I think this is going to be the approach. So I don't see anything whatsoever from our perspective as our company in terms of cost structure going up on account of the EOM regulations.
All right. Mr. Kannan, some part of the street was a little bit concerned about your losing market share. But I'm reading an Investec report, and they say that your Q4 numbers clearly indicate green shoots because there is a pickup in protection as well as reduced dependence on ICICI Bank. So you're seeing market share coming back now after losing out for the last few quarters. Do you expect this trend to move up? And do you have a targeted market share that you could give us? It dipped a little bit. I think you lost a few basis points, but now you're recovering.
Nigel, thank you for mentioning this. I do believe that we have to look at our business from an APE perspective, from ICICI Bank as well as a non-ICICI Bank channel perspective. If I look at a non-ICICI Bank in the 4 years, we have actually picked up market share. We have not lost market share. However, given the priorities of ICICI Bank, we have seen a sort of a reduction in distribution by ICICI Bank. But if you look at the numbers, as you correctly pointed out, now ICICI Bank is accounting for only 14%. So when we are only from 55% when ICICI Bank has come to 14%, the base is such that we can only grow from here on. So that is why you have seen the Q4 numbers also, actually more than green shoots is what I would say. They have actually grown a lot. And I believe that given the kind of channel mix we have, well-diversified channel mix we have, irrespective of what happens to a particular channel or a particular partner, we should be able to put out an overall growth. That's what we have come to.
Okay. One final question from my end. The IRDAI has asked all insurance companies now to focus more on direct sales and to grow that channel. Just trying to understand what percentage of your premium comes from, direct sales, and how much do you think you can grow it by over the next, say, 2 to 3 years?
So if I look at our agency business, Sonia, it's about 26%. So I do believe that while the focus will be on direct, there will be focus on agency also going forward. As I said earlier, we have invested a lot in this channel in the last financial year. So that will grow. And specifically on the agency side, we have on the direct side, we have about 15% of the business coming from direct. And that is poised to grow because technology, digital, upsell, cross-sell, all these will be the levers to push the direct business as well. So I think it is again has a leg room to grow in terms of putting out a growth which is higher than the overall APE growth for the company. So that is what we will be focusing on as well. And there we will be able to direct the products the way we want, meeting the customer's requirement, understanding the customer requirements better, and do an upsell, cross-sell as well. So that is going to be the focus. I do expect in the medium term the 15% direct going up in terms of the product mix going forward.
Mr. Kannan, before we let you go, personally, what are your plans, sir, post-June? Will you be joining another insurance company?
I will put it in two phases, Prashant. As you rightly said, up to June, I'm focused completely on the business. So I'm here till June, and the focus would be to ensure a smooth transition. Post June, I haven't really thought about it. So you will get to know when the time comes. I myself will get to know when the time comes.
There's a possibility you join another insurance company?
Not at all. As I said, I have not thought about it at all. Now, I want to confirm to you that I haven't thought about it at all as of now. And we will see what happens in June.
So when Anup Bagchi takes over, any changes? I mean, I'm sure you all have discussed this ad nauseum, but any changes in the approach to the business?
See, Sonia, the way I look at it is that Anup, I know Anup as a valued colleague of ICICI for 3 decades. And in fact, he and I were in the business school together. So I know him for more than 3 decades now. So I know his mind quite well, I presume. Second, and more importantly, from a company's point of view, he has been a non-executive director of the company for 4.5 years now. So he's been an integral part of the strategic formulation and making sure that he supports the team ICICI Prudential. So I think that part will continue. Generally, I do not see any change in approach in terms of having to grow the value of new business on absolute basis. I think that approach will continue. But having said that, each CEO brings his or her own perspective into business, which will be very valuable for the company and the shareholders as well.
Okay, all the best for your future plans. And I'm sure Anup has some big plans for the company as well. Thanks a lot, Mr. Kannan, for joining in. And have a great day. Well, that's the word coming in from ICICI Pru, but let's move on. The big talking point in the last many weeks and months actually is AI generative chat GPT that can become a big disruptor in the times to come. Now, the question we're asking it is, will it eat into IT jobs? Because that's the sense that you're getting from a lot of the large IT players. Rima joins in now. She gives us a lowdown on all of this, and then we'll take the discussion forward. Rima, over to you.
Thanks so much for that. So let's start with what generative AI like ChatGPT can do. Well, it generates content that is indistinguishable from human-created output. Think of it as a software writing a software. So you no longer need handwritten code written by engineers to develop a code for an app, for instance. You can do it via prompts. So the question is, if you can write code, I can write code, then what happens to all of India's engineering talents? Is there a risk to software jobs? Well, it's hard to say right now conclusively, but experts do believe there is a possibility that lower-end software jobs can get impacted. There was a recent Goldman Sachs report which said the shifts in workflows triggered by these advances could expose the equivalent of 300 million full-time jobs to automation. But this is a number which is across industries, not only for the technology industry. But remember, till AI gets very sophisticated, extensive human input will be required to validate the output, to check the output generated by, say, a ChatGPT. So how can this play out for technology companies? Well, for starters, IT companies may need to hire fewer people. That will help with their productivity. And there is also a possibility that at some point, the productivity benefits generated by generative AI can get passed on, which means customers are saying, give me some discounts because now you need less money to write that code. From an enterprise point of view, that's the customers of the IT vendors, will enterprises cut their technology spend because writing code, software development now takes less effort? Or will they keep their technology spend intact and use the productivity savings to focus on more technology projects? And also, the bigger and the more important question is, when does the significant impact of AI generative advancements start kicking in? Does it happen as soon as 3 to 6 months? Or is this something which is going to take time, 2 to 3 years, to become sophisticated? And I don't want to sound apocalyptic, and just to balance out the other side of the argument, worker displacement, which is generated from automation, historically has been offset by the creation of new jobs and the emergence of new occupations following the technological innovations. This is something that Goldman Sachs says, and they believe generative AI will complement and not substitute the workforce. Back to you.
Rima, thanks very much for that. That's a very comforting way to end that piece, that complement will not replace. But let's put this to someone who's looking at this closely. Put out a note as well. This is Ankur Rudra, Executive Director, Head Asia Pacific Telecoms and India TMT Research at JP Morgan. Ankur, good to have you with us here. Thank you very much for your time. What is your own assessment? Because, I mean, everything is here, like the sort of technologies, AI technologies themselves are evolving. The assessment of what they will mean for work IT services in this case is what we're focused on, is also evolving. What is your assessment currently?
Hi, Prashant. Thank you for having us. So I think the way we think about this is like with any new technology, there is a lot of disruption. Now, any disruption has both positives and potential challenges. The key positives, I think, to start with is a significant boost to productivity. This industry has seen various productivity tools come through over time. Beginning with code libraries, tools where you could store code and reuse a lot of code. There are companies which have built internal code repositories where they could store code artifacts. So that just generally improves the productivity at the developer level. Moving from there, I think the second big positive is the talent availability. A lot of these tools such as this can expand the access to technology and code development beyond just highly skilled resources. One can potentially think about a wider pool where they can use a productivity tool like this to learn languages much faster, as opposed to depending on necessarily only an engineering talent base. They can expand that a lot more. The next thing is ability to sort of create new opportunities in terms of implementing this. A lot of enterprises that want to implement generative AI or tools and techniques around it will not have the skill sets in-house or may not understand their technology estates a lot because it's been outsourced to an India tech services company or a tech services company in general. So the contextual understanding that IT services companies bring is quite crucial. Having said that, I think the key challenges that these companies face is that with every productivity tool in the past, we've seen the value eventually is passed on to the customer. So I think the value necessarily, for example, doesn't sit with the engineer or the company. So as a result, there could be an impact on pricing. Our conversations suggest the work that's been done today may perhaps need a lot fewer resources. This is probably truer for more legacy work around maintenance, whether it's applications, infrastructure, business processes, which can get severely distracted. And of course, from a pricing perspective, there can be an impact where we might see this as a deflationary tool.
Okay. So, I have a couple of questions here, Ankur. First, since, of course, our viewers are mostly investors that have exposure to some of these companies, whether it's Infosys, TCS, I was going through your report where you say that tech companies that have a stronger graduate hiring and training infrastructure, like Infosys and TCS, are better placed to retrain their staff faster than small peers. So is it fair to assume that even if they can't keep up with the disruption, at least they can do it better than some of their smaller peers, which gives them an advantage? And hence, one shouldn't be too worried about their exposure to these stocks?
I think what we've seen in the past is, this is obviously not the first technological disruption that the industry faces. We've seen, for example, digital transformation at scale, cloud, et cetera, have, come and change the way things are done over the last decade. And of course, not just the last decade, but many such changes over several decades. And, companies that can retrain staff, what you really need to do is ability to sort of build up new skill sets. I think one of the interesting things that is true about this, for example, the recent launch of Microsoft's Copilot, is how you can use technology like this to empower an existing developer. So, using existing developers or talent bases to be able to use this and use this a lot more effectively. And hence, we basically said that companies which have a stronger capability on retraining staff are probably better at doing this. We've seen their ability to sort of, go with the times has been a lot better in the past. The second thing I think we also is true is generally the implementation of these technologies is preferred by consulting firms. So we've seen in past cycles also, consulting heritage firms are generally preferred whenever there's an element of FUD in the industry, whenever there's an element of uncertainty around new technology.
Okay, Ankur, we'll leave it at that. We can go on with this discussion for an hour, but due to paucity of time, we have to end the discussion now. Thanks a lot for joining in and speaking to CNBC-TV18. So that is perhaps, one view on how generative AI can disrupt the space, how large companies can keep themselves relevant. Amit Singhi, the director at IBM Research India and Chief Technology Officer for IBM India South Asia, also joins us now to give us his view. Amit, before I ask you what the companies would be doing, what about the employees? Are people going to lose their jobs because of generative AI?
First of all, hello, Sonia and everybody. Thank you for having me on your show. I think it's not about losing jobs. I think the earlier speaker also mentioned that definitely it's going to disrupt how we execute processes, whether it's software development or business processes. And what I'm seeing, and many of my colleagues are seeing across the industry, is the end users and the employees are already adopting these in their jobs to figure out how they can be more effective. And so there's an organic reskilling that is happening. But we need to figure out as an industry how to enable employees to reskill so that we can leverage the benefits of the technology, but also help our people to reskill to these new areas, right? And I think that's possible. We've had technology disruptions in the past. Definitely this one is moving faster. But I think as an industry, we also need to learn how to move faster in adapting and reskilling our folks.
Would you agree with the assessment made by Ankur earlier that this is ultimately deflationary? When you think about from a perspective of what it does to IT services companies, I mean, bringing in the investor angle, this this is going to be, any savings are going to be passed through. So net, what would this mean for margins that IT services companies are able to make? Or is it too big a leap to make right now?
Yeah, see, I'm more of a technology guy, but I do work with our services partners. And what I'm seeing is it will definitely improve productivity of services delivery, right? So if we do it right, it will reduce cost. But at the same time, there are two important things in the market, right? There's competition, and services companies will always shoot for giving the most competitive and highest quality deal to their clients at any given point of time. So that will have a natural effect. The other thing is, I think businesses and enterprises are adopting technology more and more. So it's not a zero-sum game, right? If you look at the trend, businesses are increasingly need to adapt to competitive pressures. They need to move faster, and they're going to use more and more technology. So it's not that if I take this much services from the market, that's what I'm going to continue to take. I'll need more technology, more services going forward. So that will also add an opportunity.
What about enterprises? What will they do? Do you think enterprises could cut tech spends because now writing code or software development perhaps will take lesser effort and time? Is that the right way to look at it? The technology spends would be cut?
Yeah, see, I won't speculate where it's going to go, but I'll repeat that the amount of technology that will be used, right? Today we are talking about generative AI, then we have things like quantum coming in a few years. The kinds of new tech that is going to come up every couple of years or so is also going to be tremendous. And the potential of what businesses can do with them is going to be also net new. So it's not a zero-sum game. I think as there's maybe less spend on existing tasks around technology, there'll be new tasks and new use cases that will get added. And how that will balance out, whether it's going to increase or balance out is something to be seen.
All right. Thank you so much for explaining that to us and, to make us understand how both companies, employees and even enterprises that use these tools, right, how they're going to sustain at a time of disruption. But we had a chat with the management of HCL Tech on how AI tools are improving productivity and what this means in terms of hiring as well. Listen in.
The gross hire requirement itself of the company is going to come down. There are two factors that basically drive that. Number one is the attrition. So you would have heard that our attrition in the March quarter this year was roughly about half of what it was in the June quarter last year. I mean, AI tools is one part of the overall automation. It is a whole combination, so that will also impact.
Okay, well, that's the HCL Tech management. Just a few names I want to highlight, but there was a market slip, right? I mean, like yesterday, like the day before yesterday, on the index, the indices have gone to sleep. 13, 14 odd point, cut now on the Nifty. But look at Nazara, which is up about 8%. It started slow, started in the green to be sure, but now it's jumping up on very good volumes. Liberty Shoes is up 7%. It was up, I think, 10, 11% at one point. It's come off a little bit, but after yesterday's 20% move, there seems to be a break here, clean break here higher. Tata Investment Corporation, that is up 6% on very large volumes. I mean, again, something which was not there early on amongst the gainers, really. Delivery is up almost a full 5% now, 352 on delivery. There is Mirza International. My God, I mean, this one really keeps ripping higher and higher. I think for the week, I don't know if I'm seeing this correctly, for the week the stock is up 80%, 81%. That's, I mean, absolutely, something, quite something, isn't it? PNB Housing is another one which is looking up. Markson's Pharma is up about 2.5%. So lots of these mid-cap names coming into the mix at this point in time. JN Irrigation may be another one which is up about 4% or so in terms of what is doing well. Having said all of this, market breadth has slipped into being in the negative now. You've got about 1,200 stocks which are lower and about 800 stocks which are higher at this point in time. We'll take a very quick break here. Mitesh will be with us with some technical trading ideas. Stay tuned. Okay, welcome back. 15 points lower on the Nifty. We are at 17,610. Mitesh Thakkar is with us with some color on the markets. The color is a little red right now, Mitesh, but the indices are in a bit of a slumber phase for the last 3 days now, Mitesh. Do you reckon that could change? In which direction, if so?
You're right, Prashant. I think, it's been red for the last, and this is the fifth day, we'll get a red candle possibly. But even then, I think, the first day's low, which was 17,574, hasn't really been taken out on the downside. So it's still a market which is, I would say, shopping around. The base building now is happening towards the lower end of the range. But 17,550 for me remains the clear marker. I think till we start breaking below that, stay positive, nothing to worry about. And on the stock side also, I have got buy calls right now. A buy on BPCL, and the refining stocks have done well for the last few days. So BPCL is a buy with a stop at about 340 and a target of 356 can be looked at. And the other one is Apollo Hospital. That's moving above the 200 average with a slightly positive chart setup. So this is a buy with a stop below 43.50 for targets of 44.45.
Okay, by the way, Cyient is at a fresh 52-week high right now. So it's had a super run this year. Cyient is up almost 45%, bucked the trend completely. Mitesh, on Cyient, this 1,154 price, is the risk reward still favorable or not quite now?
See, well, that's the stock, which I have been very positive on the long-term charts, and morning also we discussed that the stock is possibly heading towards 1,300. So I'll maintain that. It's come off the highs a little bit, but there's a gap up which has happened today, and with this gap, it's getting past the earlier weekly highs. So, and today is a weekly close. So unless until you see the stock decline all the way to 1120 today, I would stay positive, and I think 1,300 is the next trading target here.
Mitesh, what about some of these metal stocks? We had a good rally. They were showing signs of strength. But I think overnight, again, this recession fears have come about, and that's why commodities have corrected. Any view on JSPL, NMDC? They were shaping up well, but that's all got sold into in a single session.
Yeah. So, there has been some selling happening at the higher levels, but the setup for a few of the steel names, at least the first names, I think to me is positive. Jindal Steel Power, if you look at it, I think, rallied from about 535 to about 590 is giving a pullback today. But again, around 560, 562 is your retracement level plus the 20-day average. So I think that's where you would want to see if the stock can hold those levels, possibly take a long again. Similarly, for JSW Steel, the corresponding level is closer to about 697, 698, and another percent down. And I think, we'll look for some kind of reversal setup on the infrared charts to take a look.
Okay, Mitesh, thanks a lot for joining in and have a good day. Let's slip into a quick break. On the other side, an exclusive conversation lined up with Rajiv Bajaj, the MD of Bajaj Auto, to discuss his views on the Indian government not in favour of extending the EV subsidy scheme, which is the FAME scheme that may not be extended beyond March 2024. What's the impact it would have on the industry? More on that coming up.
Welcome back. Well, the banking stocks are under some pressure, it seems now. So from starting off in the green, the Nifty Bank has moved to the low point of the day, and the breadth of the market as well is now in favor of the number of stocks that are declining. But a couple of stocks are doing well. Vodafone Idea as well as Indus Stars. Rima joins us to tell us why. Rima?
Thanks so much for that. So Kumar Mangalam Birla is back on the Vodafone Idea board after a hiatus of almost 20 months. He had stepped down in August of 2021 when he had written that letter to the government saying, please, take over the company if you want. But things are looking a bit challenging. Yesterday, the announcement came on the exchanges that Kumar Mangalam Birla has been inducted as an additional director effective 20th of April. He will be non-independent and non-executive. This will be subject to shareholder approval, and this move infuses confidence of the Aditya Birla Group backing the telecom business Vodafone Idea, which is struggling because it's been unable to raise some money. Its 5G rollout has been lagging peers. So this move infuses confidence. That's the reason why the stock has surged in trade. We're also watching Indus Stars because remember, Vodafone Idea owes dues to Indus Stars. So if Vodafone Idea is able to turn things around, raise some money, it bodes well for the receivables that are due to Indus Stars. Back to you.
All right, Rima, thanks a lot for that. Vodafone Idea up 8%, but let's not forget the base. It's just a 6 rupee stock. But moving on, there's a lot going on in the electric vehicle space. The Indian government is not in favor of extending the electric vehicle subsidy scheme, which is the FAME scheme, beyond March of 2024. However, a final decision has not yet been taken. EV subsidies, we understand, to the tune of 1,200 crores have been on hold for more than 13 EV players for close to a year now. Joining us now is a formidable player in this value chain. Rajiv Bajaj, the Managing Director of Bajaj Auto, joins in to talk about this and, of course, other issues to do with the company. Rajiv, always a pleasure speaking with you. Thank you so much for joining us on the channel.
Thank you.
There are two issues currently, right? Both related to subsidies. One is on players for not following the localization guidelines, and the other is on players for their pricing strategy. What is your view now on the government's stance on each of these issues, and how is the Bajaj Chetak placed in the light of this? Are subsidies also stopped at the moment for Chetak?
So, morning, Sonia. So the short answer to that, to your last question is no. As of now, we have not had any such adverse remark from the government. As far as these two issues are concerned, quite frankly, since I'm not privy to the specific situation of individual companies, it would be very unfair for me to comment. But in general, this is what I would say. As far as localization is concerned, if those norms have been flouted, I think one should consider to the extent to which that's been done. If it's a minor thing, then I think given that, we are all dealing with something new in very uncertain times for more than just the reason of COVID. I think one should take a practical view of that and move forward from there. If it's more than that, then it's another matter. As far as pricing is concerned, I have a slightly different view on this matter. I have not understood what the logic is for a cap on two-wheeler pricing, for example, to be 1.5 lakhs of rupees, because that is the bone of contention as I understand it. I mean, today you can buy a 20 lakh car and get a 2 lakh FAME subsidy on that, and that's absolutely fine. But I cannot buy a 20 lakh motorcycle and get a 2 lakh subsidy on it. Why? Why is FAME concerned with how many wheels there are on the vehicle? An electric vehicle is an electric vehicle. So I think the bigger issue here is that the government has, stipulated something which is becoming a problem. And I would seek, or I would say that they should try to fix that problem. Because if indeed, and I don't know if that is a fact, if indeed some manufacturers have found a way around that, why would they do that? These are all very reputed companies. Obviously, pricing is a pressure, cost is a pressure. And I'm not saying that justifies doing something wrong, but I just don't see the logic of 1.5 lakhs. And just to finish on that, let me tell you, earlier this week, I met some very, very senior people in Delhi, government people. And in fact, they believe that this rule is rubbish. So I think if you fix the rule, you fix the problem.
The larger question, Rajiv, is can the industry manage without subsidies after March 2024, right? I mean, how much do you think the industry could get hit? Are we at an inflection point yet where even if the cost goes up by, say, 50, 60,000, it shouldn't matter to a consumer? Or are we still far out?
Well, there's several questions there. 50,000-60,000 is, of course, not small for any consumer. In the last 3 years, the prices of two-wheelers have gone up by about that much, as you know, for various reasons. And you've seen how that has impacted demand. So for sure, that kind of a price increase will have an impact. Having said that, I must say that I am not a fan of subsidies of any kind. And I do not think India is going to build a EV future based on subsidies. You know, look at the last 30 years as an example. We've gone, and I'm talking of the two-wheeler, three-wheeler industry, from having simple air-cooled two-stroke engines to having four-stroke, four-valve, DOHC, liquid-cooled, fuel-injected engines. We've gone from BS0 to BS6. Surely that has also cleaned up the air a little bit. Otherwise, why have we done it? Now, was there a rupee subsidy offered for this? No. Look at exports. Bajaj has gone from exporting virtually nothing 15, 17 years back to today exporting half of what it makes. Has that been driven by subsidies? Did we get a 50,000 rupee per vehicle subsidy to do that? No. So I don't think businesses build R&D or exports or technology on subsidies. And I don't think, subsidies is going to help. So there's two sides of the coin. On the one hand, therefore, subsidies going away, in my view, should not really have that bigger impact in the long run, because the future of EVs in India will be built on the back of sound strategy, not subsidy. Subsidy is not a strategy, and in my view, subsidy disrupts strategy, subsidy masks reality, and subsidy blunts innovation.
Rajiv, hi, good morning. What is Bajaj's, just to narrow it down to Bajaj's own strategy on the EV side, if you can explain briefly? And also, export markets, as we all know, and I think you've also alluded to it, are suffering for a variety of reasons. Would you look at exporting the electric Chetak, for example, or on the EV export side, what are the plans?
Hi, Prashant. So our strategy is twofold, to put it simply. One, in our existing business of motorcycles and three-wheelers, we are, working very hard to get the electric three-wheelers out. Basis, as Rakesh has been telling you repeatedly, what we think the consumer is looking for in terms of certain performance metrics. And I think any day now, we are ready to begin, with sales of our e-autos and e-cargos. And again, in the context of FAME subsidy, let me tell you this, that I don't know about trucks and buses, but our math clearly shows that e-three-wheelers are sustainable without a rupee subsidy, for obvious reasons, because the OPEX is very, very favorable. So why somebody finds it necessary to offer subsidies for electric three-wheelers is not very clear to me. So that's one activity we are engaged in, electrifying our three-wheeler portfolio. And the second, as you perhaps are aware, we have a subsidiary now called Chetak Technology Limited, where we have one Chetak, and it will be our endeavor over the next few years to build a portfolio of Chetaks. It's no secret that we are inspired by the kind of work that BMW has done with the Mini, or Piaggio has done with the Vespa, in creating really iconic brands and beautiful products for the world. And our effort is to, make the Chetak brand and the Chetak portfolio something like that. So we will go down that path. For both of these, India is the biggest market, as you know, for two-wheelers and three-wheelers in the world. So largely we will be focused on this market at first, till we get everything right in terms of technology, quality, cost, consumer experience. But at the appropriate time, of course, we will look at overseas markets. Rakesh has shared with you that he has 2 or 3 markets in mind for the near future, but I would not say we have any immediate plans.
All right. Hi, Rajiv. We have heard your views on the electric vehicle space, but, Rajiv, we speak to Mr. Sharma. The last time I spoke to him with regard to the Triumph, he told me, Nigel, start saving some money. You're going to be seeing it sooner rather than later. So I wanted to ask you, give us more details on the partnership. What kind of, how many models will you be launching in the next few years? Any target out there? Because as an avid two-wheeler, I love to ride these big bikes. I've been waiting by, and I don't think we have been spoiled for choice in the last few years. So we want to be spoiled. Go ahead.
Okay, so I can put some color on that. The actual launch, I think, will be towards end of June, perhaps specifically on Tuesday, 27th of June in London. It will be a global launch that is being organized by Triumph. What exactly is the content of that, I'm not aware. But that's when the launch might be. So I saw that program where you speculated it might be more towards the end of this year, or someone speculated, but no, it will be in June, which means we should have product in the market in the second quarter of this financial year. Clearly, there's more than one product under development. I can also say that more than one product will be launched in the second quarter if all goes well. Get your checkbook ready, Nigel.
Rajiv, it better be impressive enough. There's an Enfield loyalist biker here sitting.
Who's looking out? Who's looking out for an option?
So if he's got to make that transition, it better be impressive.
Yeah, we all have to move on in life. He has to move on from the Enfield.
Okay, we're looking forward to that. A launch in London, 27th June, right? Is what you said?
I think so, yes.
Okay, all the best.
It's a Tuesday. He's also given the day. I mean, it's locked.
Are you excited, Nigel?
Absolutely excited. And as you said, Enfield loyalist, the 350 standard, has ridden the Machismo. Currently, it's the Interceptor. But I'm looking forward to this baby, and hopefully it's not going to disappoint. Checkbook's going to be ready.
All right, there's a new one coming up in 2023. Thanks, Rajiv, for joining in.
Thank you both.
Right, well, that's on Bajaj Auto, and all the talk on EV disruption, on the FAME subsidies being revoked, perhaps from the government, and their new launches as well. Let's move on. For the market, it's actually moved into the red, so don't lose sight of that. The mid-cap index is now down 200 points. But a quick word on the commodity space as well. Manisha Gupta has been waiting by. Manisha, thanks for waiting. Anything that stands out for you that's interesting in the commodity markets today?
Well, Sonia, I'm looking at the metal prices, and most part of this week, we did see buying continue here, but the last couple of sessions have been a bit of a disappointment, and you can see that red across many of these metals there. Well, it has been uneven economic recovery in China. Most of the economic data, pardon me, have been on the positive side, but not all. And the US economic data, all of them have been slightly on the weaker side. And then there are expectations of rate hike, not one, but two coming in from US, and not two, but three coming in from Europe, and that's what's weighing onto the markets. Add to that, the Reserve Bank of Australia statement saying that their rate pause was temporary is how it should be read, and that's weighing onto the markets. I'll start with steel because the biggest of declines really have come in for this one. We're trading at a 16-week lows for the steel prices right now. That is because the demand on ground is not so strong. Infrastructure and construction numbers have been slightly on the weaker side, and even as this is going to be a third straight year when China output is going to go down and by nearly 2.3% in this year, that also hasn't led to prices staying in the positive there. And a decline in steel has led to a decline in case of iron ore prices as well. And for iron ore, we are looking at a third monthly decline here. It's trading at a 3-month lows as well. Here as well, when you look at the supplies, they have been on the positive side. A statement from Rio Tinto says that they have seen 15.4% jump in case of sales for the month of March there. A similar statement coming in from South Africa. The first quarter production has gained up by 5.8%. Australia as well, the cyclone did not come, and we have seen supply concerns there as well evade too. The China NDRC on the other side is closely looking to monitor the spot prices, dynamics, and if or not there is any manipulation happening. And we have seen margins increase as well when you want to trade iron ore, and that's weighing onto the prices in addition to that. We also are looking at certain steps that China has taken to ensure that the prices do not break a certain cap on the higher side. China, remember, stands for 70% of world iron ore imports. So much of the news that comes in from China is what impacts iron ore prices across the world. Well, that's about the ferrous markets, but the non-ferrous metals also have been trading on the weaker side for last couple of sessions. Copper prices have come off their highs, actually are trading at a 1-week lows on your screens right now. Not just copper, zinc prices are now trading at a 5-month highs. You have aluminum prices, which also have seen a decline to nearly 2-week lows. Zinc especially has seen inventories gain up by 21% in last 2 trading sessions. So that bit of a price gain that we saw clearly has been made use of. This is what we've done in this week for the metal prices. Everything trading in the negative. The major decline, as I said, has come in case of copper and steel, 2 to 3% down there, and nearly half to 1% down for iron ore, zinc and aluminum as well.
Manisha, thanks very much for that. That's basically metals in focus. By the way, market breadth is now 2:1, almost fully 2:1 in favor of declines. Oberoi Realty is down 4% on decent-sized volumes right now. And there is Gland Pharma, which is down about 4% as well. I already mentioned SW Solar, but these steel stocks are also coming up with losses. Jindal Steel and SAIL both are down between 3 and 2%. So keep an eye on some of these names. The Nifty is down about 31 points. It's a wrap on Bazaar. Chartbusters comes up next.